Welcome back to the Educated HomeBuyer, where our goal is to help you buy right, borrow smart, and build wealth through real estate ownership and financing. So, Josh, everyone wants to buy at the low, sell at the high, essentially time the market. So, in today's episode, we're going to talk about the idea of timing the market. Can you do it? Is it realistic? Who are those that can actually get away with trying to time the market versus, the typical buyer and seller out there? So, Josh, let's start today by talking about what does it actually mean to time the market?
Pretty simple. It means that I am going to wait for an optimal entry point when prices are lower today, or in the best case, the lowest possible, and buy in at that point, and or sell when prices are at a peak. And the reason why we're having this conversation today is we don't know if prices are at a peak, but historically we are at the current peak. If they do not go higher, this is the highest home prices have ever been. Not necessarily in real terms, meaning inflation adjusted, but in nominal terms, the actual dollar cost of any home that you buy today is as high as it's ever been. So you and I, mortgage professionals, real estate professionals around the country, hear this all day, every day, and mainly from first-time buyers. Who's most concerned with getting the timing of their entry into the market right? It's not someone that's selling a $500,000 home to buy a $700,000 home. There's a little bit of risk there. It's the person who doesn't own a home at all and is entering at
Absolutely.
$300,000 or $400,000.
Yeah, and it's scary. I mean, a lot of people are, again, we've talked about this on other episodes. People, have memories, if you will, of not so long ago, 10, 15 years ago. How long has it been now? 15 years ago, 2008, when we had a housing crash, right? People, with regards to home prices and talking about a peak in prices, that was essentially the peak at that time. And so everyone wants to relate it back to then. But, timing the market is difficult. It's difficult in real estate. It's difficult in the stock market. It's difficult in crypto or whatever it is that you're trying to buy at a certain price and sell, maybe or think that you're trying to sell at a later price. But, Josh and I, before we talk about the idea of your house being your home and that sort of thing. I always like to tell this story because as a real estate agent, I often have conversations with sellers, and sellers a lot of times that have owned their properties a very long time. And so here in Huntington Beach, a lot of the properties, were built in the 60s at some point. And occasionally I'll come across sellers that have owned their property since the 60s. They still own that same piece of property. Maybe they live in it today. Or maybe at some point they turned it into a rental property, but they still own it. And oftentimes that conversation goes a lot like, I bought this house for, $20,000 or maybe $80,000. And at the time I had no idea how I was going to afford to make the payment, but I needed a house for my family. We were growing or whatever. And I thought there's no way home prices can go up from here. And here we are today where home prices are up tenfold, 12-fold, 20-fold, depending on where you're located from that original price. And, the idea of buying a house, too many people today are treating it like an investment versus somewhere that you have to live. So, Josh, let's talk a little bit about that. For most of us, our house is our home. It's not an investment.
And that's the critical difference here in terms of thinking that it trades solely as an investment. So if you buy crypto, for the most part, why do people want crypto? Because it's going to be worth,
It's
or
going to
they're
make me
hoping
rich, man. I'm going to be
they're.
able to retire.
And how and why? Because it's going to be worth more in the future.
Right.
But today, none of us own crypto for its utility. You can't use Bitcoin for much of anything. Yeah, you'll go into a place that says, "Hey, we accept Bitcoin." Has anyone ever
Unless you live
paid?
in El Salvador.
Even at that, I doubt that Salvadorians are running around rapidly paying for things with Bitcoin. But the difference is it is a pure investment. Same thing with Tesla stock. What are you going to do with Tesla stock other than hope that Tesla continues to go up? So as soon as people become convinced that Tesla stock is no longer going to go up, they will sell it. Transaction costs are very low. Very easy to do. You go onto your computer in about 2 minutes. You don't have to consult any professionals. You don't have to clean up your house. You don't have to take pictures. You don't have to put it in the multiple listing service. You don't have to leave for weekends while open houses are held. You don't have to negotiate back and forth with buyers and sellers and then do inspections, appraisals, wait for contingency periods, loan approval, and then pay anywhere from 5 to 8% of the value of your property. If you go and you own 1,000 shares of Tesla, you're sitting on a gold mine, but you don't have to pay 5 to 8% of the value of those shares when you sell it. So long way of saying, you hit on the important part that it's not just an investment in that it actually does something for you. We all need shelter. So what are your options? You can rent shelter from someone else. You can live rent free with friends, family, the government, whoever is going to put a roof over your head, or you can own. Over time, more than 60%, nearly 70% of American households choose to own. And if they sell because they're going to time the market, they have to go to one of those other alternatives. And that's a very small minority that's okay, a minority of Americans that's okay with going from owning their home and having a place of their own to sharing a home with someone else where it's free, or having it provided for by the government. So there's strong resistance to that, which keeps prices sticky to the upside, which we've talked about a lot. And then the transaction costs are another reason. If you thought that you and I looked at an article this morning, the guy's projecting that in the next year and a half that home prices are going to drop 5%. You don't save anything by selling your house. You're guaranteeing that you're losing 5% of the value of your home, and you just gave up your shelter. So one of the really big reasons why single family residences and condominiums and townhomes do not trade and perform the way most people think of an investment when they're watching stocks, bonds, gold, crypto, that type of stuff.
No, and that's the thing is that, I've had clients many times over the years try to time the market. And let's, I'm not crapping on anybody that wants to get a property and get a deal and have it appreciate over time, because that's the goal for all of us. I just don't think you can go in with that mindset initially, unless you're an investor. And we'll talk about that here in just a minute. So, clients over the years have thought, back, and I can take you back to 2019. Home prices at that point had again, they were at a peak at that time because they had surpassed levels of 2008. Most home values had reached back above where they were at that time. And people thought this is it. And they sold their property with the idea that, hey, listen, I'm going to wait until the market pulls back and then I'm going to re-enter. Well, we saw the craziest appreciation in a 2-year period that we've ever seen historically, where there were gains somewhere between 30 and 40% for many markets out there. And those people that sat on the sidelines hoping for the pullback, well, they really got screwed because the market continued to appreciate, and no one knew that was going to happen. And that's, I guess, the concern or the idea is that, regardless of what you think the market's going to do, the saying is that the markets can remain irrational longer than you can stay solvent. And so in the idea that, hey, listen, the markets are irrational, they have to pull back, or, this stock is acting crazy, it has to pull back, and then the markets continue to accelerate. That's, unfortunately, timing the market is very, very difficult, Josh.
Well,
So,
Jeb,
yep.
that last thing you said, irrational, another word for that. You and I looked at a piece of marketing from an investor who's really tuned into home values and home economics,
Yep.
the economics of buying and selling real estate. And his word was, this is clear evidence that we've reached a euphoric stage. Euphoria can be defined as a form of irrational.
Yep.
But is it? It's easy for us to look back and go, this is irrational or this is euphoric. But I can also give you the reasons why this happened. Markets don't just go nuts. Home values dropped. People were able to become location independent, move to different parts of the country
Yep.
where homes were lower priced and they could take their income with them. We were locked in our homes. Home became more important. We had government stimulus, so people had money in their pockets. We had an inability to go out of our homes and spend money, so saving was easier. So if I told you all those things were going to occur and asked you, what do you think is going to happen with home values? You would rightfully go, well, they're going to go up. None of us projected they were to go up as much as they did, but it was a rational outcome based off of the inputs that buyers were getting the last few years. So I question calling something irrational just because it's above where it has been in the past.
Well, that's fair. And so one thing you didn't even mention there is the idea of interest rates reaching all-time lows. And so you had buyers out there that were kind of pent up, that were probably buyers at the early part of 2020 that because of the pandemic and maybe job situation or whatever got put on hold and kind of pushed them towards the end of 2020, maybe even into 2021. And then you had, we've talked about this, maybe some demand pulled forward back, in that 2021, early 2022 period, because interest rates were so low, buyers looking to take advantage of the market then versus maybe now or in 2023 or 2024 when their original time frame was to buy it. They wanted to take advantage of the market then. And we had the low supply. Why? Partly due to demand, partly due to a lack of building, just a lot of factors thrown into the market that created, euphoria, if you will, with regards to home buying. And so again, just getting around to the idea that it's difficult to time the market. We've talked in the past about when it's a good idea for you, right? It's everybody's timing isn't going to be the same. Me buying a house for my family is going to be different than maybe the reasons that you're buying a house, for your family. Or what have you. So you just got to, make sure you're making the right decisions for you. And we've talked about episodes in the past where, why home ownership is important with the idea of when it's a good idea to buy a house. So go back and check out those episodes if you haven't heard them. But let's talk about who can time the market, Josh, and then also who is most affected by trying to time the market. So first, who are the people that should be or are a little bit more able, if you will, to time a market like we're in now, or any market for that matter?
Well, there's a giant difference between, let's just say, three different groups. There's investors, people who own real estate purely for its cash flow and its ability to appreciate and to improve their financial future. There's homeowners that currently own their home and have been long-term homeowners. Then there's recent home buyers and first-time buyers looking to enter the market. So the difference between those two groups is first-time home buyers and recent home buyers haven't had time to build up a bunch of equity in their home. They haven't got time to adjust to the thought, I'm a homeowner, I own my home and I live here. So kind of would be more open to the idea of getting in and out. So going back to that, an investor is probably going to take a long-term time horizon. Now, if they bought in 2013, when we're still near the lows and they've seen that home go up, 200% in value or 100% in value, 150% in value over the last 10 years, there's some investors out there that would say, hey, you know what, this is a peak. I never thought this home would be worth this much. I'm getting a little bit older. My father-in-law recently sold 2 duplexes that he built back in the 90s. Never in his wildest dreams did you think they would be worth what they are today. He's in his 70s. He's like, I just don't want to deal with it. I don't want to deal with the maintenance, the headaches, the trouble. So for him, it was a good time to sell. So investors can do that. Investors can look at something and saying, hey, I have this property. It's kind of a crappy property next to the train tracks. It's a 1-bedroom. So we've had a hard time selling it, keeping good tenants in there. That value is high enough that I can take that and get a 3-bedroom, 2-bath on the other side of town. So they're not getting out of the market. They're using this as an opportunity to rotate up, or they might get out of the market and come back in a year or two if and when home prices drop. You have that group in the middle, the long-term homeowners, both you and I don't think it's something where we'd sit here and say, hey, let's uproot our families and give up our long-term homes. You've been in yours almost 10 years. I've been in mine almost 20 years. That's not generally a thought for those
Well, the
folks.
difference in the two is typically an investor owns their primary home and then they own investment properties outside of that. Some investors might just own investment properties and not own a primary home. They may rent. That's typically not the way it goes. But with the person that owns a primary home, by selling an investment property, it doesn't change their life. They don't have to worry about shelter. They don't have to worry about, where do I go if I sell this property? What if the market, continues to move up from here? Because it's an investment, right? Because they're looking at it differently than that of a homeowner. So it makes it gives them an opportunity to look at it a little bit differently versus the homeowner that owns their home. Me, say today, I decide to go sell my property. Well, if I sell my property and buy something, comparable, right? Family of 5, we need at least a 3-bedroom, 4-bedroom, preferably. If I go rent a property in this market today for what my family needs, in my market, I'm paying minimum $5,000, probably $6,000 to $7,000. And guess what? That's double what my current housing payment is. So that to me doesn't make any financial sense. Well, I could go sell and buy something else. Maybe there's an opportunity there. But if I sold and sat on the sidelines waiting for the market to pull back, I would have to wait for the market to pull back considerably to even get something close to what I have now. So it just, I was fortunate that when I bought in 2012, it was the right time in my life. First child, just got married, looking, for something to call my own. Just happens to be that I caught the market before it started to accelerate. And I'm not even as a real estate agent, I'm not looking at the property worrying about what the value is going to be tomorrow. I'm thinking, can I afford to make this payment? If the market turns, real estate sells, slow down, can I continue to do this? Is this the right house for my family? Is this the right location? Is this where we want to be when the kids start going to school? Those are the things I'm considering versus what's it going to be worth tomorrow, Josh?
Same thing. My mortgage statement came last night. So we're sitting down to dinner. I popped it open and I don't look at it. It's on auto payment. But for whatever reason, I looked at it last month or last night and saying it would cost somewhere $5,500 to $6,500 a month to rent my house. We had a couple $1,000s a month savings to that. $1,300 of that goes to principal every month, just principal reduction. So I don't have that money anymore. I have to write that check, but it's essentially I'm putting it into a savings account over there. So in real terms, what does it cost me in interest, taxes, insurance to live in my house? It's about $2,500 a month, less than half of what it would cost to rent it. So it's not really a viable option to sit out and try and time the market. And Jeb, one of the things that we didn't go into that I want to touch on briefly is everyone likes to think that they have the emotional control to just irrationally, rationally and dispassionately think about the home purchase and home prices. I can tell you, you guys probably get tired of hearing me say this. 2010, 2011, 2012, 2013, I was screaming from the rooftops to anyone that would listen, buy a house. You could go out to one of our first time markets here like Anaheim and buy a home for $300,000, $325,000. It costs less to own it than to rent it with a minimum down FHA loan. Even here in Huntington Beach, low end entry level 1,100 square foot homes were going for $450,000, $475,000 at that time. Anyone could have, should have, would have bought. And yet you would tell people, and because home prices had dipped and the memory of 2007, 2008 was so strong in their mind, they wouldn't buy. When we bought and flipped our first house in late 2008, people told us we're nuts. I'm like, well, we're buying it for $265. The guy paid $685 for it. And yes, there's a very low $685, like 2.5 years before. There's a very low volume of transactions going on, but there's also a very low volume of nice homes on the market. So we're going to take 50 grand, make this thing really nice, add another 50,000 profit onto it and sell it. And we did. So we sold it low because the market was low. And that guy ended up buying, I think, 385, 395. He bought that $265,000 house from us. And here, still owns the house 13 years later, 2008, 14 years later. And that house would be approaching $800,000. He bought for less than 400. So long way of saying the emotions of being able to set aside that fear that the market's going to drop more and step back in at the right point and not wait to see home prices start going up again. It's just most people don't have it. They don't have the ability to emotionally sell their house at the top of the market and go rent something, and they don't have the ability to step back in emotionally when they see a bottom or what should be a bottom.
Well, I think that's the caveat there, right? Is that, even when the market starts to pull back, which we've talked about it, that there's a possibility that you see some price declines in some markets out there. When the price declines happen, most of those that have been sitting on the sidelines are going to be timid. They're not going to be the ones jumping back in the market at that time because they want hope to see prices go down further. But the smart money, the investment money, is out there buying those properties. And guess what? By the time those people that said they would be buyers if the market pulled back, but by the time they've decided to buy, many times the market's gone back up. But Josh, here's what I'll say. Before we talk about who's at the greatest risk of timing the market, which we've kind of hinted on a little bit, what do you say to the person that's looking at you and I going, well, you guys have owned your property 10 plus years. You guys have a ton of equity. You're fortunate enough to get a super low rate locked in. So yeah, of course you don't have any concerns, but what about me? I'm a buyer coming into the market today, looking at where home prices have gone. interest rates are up. Like, how do you approach that person looking at today's market?
I will acknowledge that all of those things are true. And it is not, despite what some people will tell you, it is not always a great time to buy. You have to look at your finances, your ability to make the payment, not stretch beyond your means, and make sure that it's the right time in life for you, because we're absolutely at elevated prices right now, which increases the risk to an entry buyer stepping into the market. But the best story I can tell you is a friend of my wife's, her parents bought. We did a loan for them in 2006. We told them all of the warning signals. Home prices are at a high. This is what it is. And they had told me, I've rented for the last 18 years. We paid $265,000 in rent through that time. I'm not going to do this again. We're going to live in this house for the next 20 years until we retire. And I don't care what happens with values. We both have good jobs. We've been on our jobs for 15 years. We can afford that payment. We're going to sit here and make it. And they bought darn near the top of the market. It dropped about 40 to 50% from where they purchased it. They still live in that house today, and it's gone up 120% from where they purchased it. And now they owe $250,000 on a $1.1 million, $1.2 million property. So that is the absolute perfect inverse of timing the market. They bought near the top and then just held and rode it out. So that is the thought process that you have to think. What's the worst thing that could happen? What happened to them was the worst thing that could happen, and it was not a problem because they had a long-term time horizon. So that's what I say. Don't think that you're going to get rich quick in real estate with prices where they are today. Don't think that you have to buy and make a pressured decision to get into the market. But when everything else lines up, your finances, your life stage, all of that, your desire to own a home, and the stability in your life in every regard, when that lines up, I wouldn't be afraid of buying in this current market. I would be cautious of buying in the current market.
No, and that's great advice, Josh. I mean, and that more or less leads us into that last question that I was mentioning earlier, and that's who's at the greatest risk of trying to time the market. And you've already mentioned one is those that have a shorter term time horizon, those that are already know that they're not going to be living maybe in the same city, the same area, the same job, same state in the next 2 years, right? Those people are at a higher risk of having something negatively affect the value of their home, or not necessarily the value of their home, but maybe not having the equity there based on transaction cost to sell a property to be able to come out ahead. If the market moves sideways or if it goes down a couple of percent, those that have the shorter term time horizon are the most affected. I mean, I saw a graph that came out last night that I'm not sure if you've seen it, but I can send it to you, and it shows, basically when home prices peaked and how long it has taken to get back to that peak in the future. And I think during the 80s, it was like 11 years, from peak to trough, back to peak, where that peak meets. And then in 2008, I think it was 14 years that it took to go for some markets, not every market, some markets appreciated faster, but from where the peak was in, say, 2006 to get back up was 2020 for many markets out there. So it took a 14-year time horizon for that to happen. But over time, prices have continued to rise. So those with the shorter term time horizons could be affected. You mentioned earlier first-time home buyers, Josh. Why first-time home buyers?
Simply because they don't have the big down payment. A move-up buyer has built up some equity. Use yourself. You would have a very large down payment if you sell your house and buy into a new home. So you wouldn't be at risk of a home price crash because you would have a bunch of equity. Now, if you were looking entry-level home in this market and you want to go buy an $800,000 house, 5% down, a 5% market correction is pretty easy to occur. So first-time buyers just don't generally have the skin in the game in terms of equity that they're putting in terms of a down payment. They haven't had the last couple of years that a first-time buyer in 2020, they're not at risk. The market's up 35%. So say they put 3% down, they have almost 40% equity in their home. And again, they didn't know that at that time. We had every reason to believe that 4, 5, 6% appreciation was coming, but not the monster appreciation of the last few years. So there's always a little risk to a first-time buyer, and the reason why it's not there for move-up buyers is because they've had the opportunity of time, appreciation, and principal reduction to build up a little nest egg and have more money and more investment into the new property.
No, and all first-time home buyers aren't necessarily going to fit into that category, right? We're kind of profiling a little bit with regards to first-time home buyers. Those first-time home buyers that are putting large down payments down are going to be less affected by that sort of thing. But it's typically the people putting less money down in a market that moves sideways to down a couple percent are going to be affected the most. And those, lastly, that aren't buying for the right reasons. Those that are truly buying because they saw a video online or trying to house hack or trying to do something where it really wasn't the right time for them. They were just trying to make money in real estate. And sometimes that works out, but sometimes it doesn't. Buying, with the fear of missing out isn't the right reason to buy a house. We mentioned it earlier, getting married, having a fiance, having kids, or whatever it is in your life plan, and you need more space. You're ready to set down your roots, build a foundation, if you will. Those are the right reasons to buy real estate versus, the idea of truly trying to buy it strategically to make money, and trying to time the market, Josh.
For the vast majority of people, for all of the reasons that we mentioned, timing the market's not a reality. You're not going to do it. You're not going to do it successfully. So the important thing, again, is to step back, analyze the market, know logically and realistically where we're at, and know yourself and where you're at, and have a long enough time horizon that it doesn't matter. Now, if you've owned homes for the last 40 years and you've bought and sold and you're really in tune to market cycles, and you want to take that risk, by all means. But Jeb, how many people did you and I have in 2020 and 2021 saying, oh, this market's nuts, I'm going to wait until next year, I can save up some more money and I'm going to buy at a lower price?
So many that it would take a full episode to name them all. So here's the deal. If you're looking at the market, wondering what the second half of the market's going to look like, we filmed an episode last week giving you a mid-year forecast as to where we see the market headed. Josh and I's thoughts, based on where we've been, where we are now. So take a listen to that. Let us know what you think. But in the meantime, we'd appreciate it if you rate and review us on your on whatever podcast platform you use. We appreciate it. We'll be here again next week, giving you more information to help you become the educated home buyer. Until then, we appreciate you listening. Have a great day. Adios.